All right, let's get in an opinion on the TCS numbers and the way forward. Sudheer Guntapalli, the lead analyst of the technology sector at ICICI Securities, joins in. Sudheer, you have downgraded TCS post the numbers. Can you tell us why?
Sure, Rima. If you see 2-3 points on this front. First and foremost is that if you look at the growth rates, of course, there is a bit of an impact due to the sharp decline in the India business. Even if you add back that part, let's say 70-80 basis points to the growth, the overall growth the company would have done on an organic basis in constant currency terms this quarter would have been in the range of around 3.1%. And if you look at historically, the 5-year average before COVID, both for TCS and for industry, it should be noted that June is seasonally the strongest quarter, and the growth rates would have been higher than that 3.1%. So my belief is that the industry and in fact TCS also are kind of seeing a reversion or convergence towards pre-COVID long-term average growth rates. That's one key point. And the second point, if you see, the company has also sounded off a little bit of caution in terms of the softness in Europe for the next at least 1 to 2 quarters. That's the second point we need to keep in mind. But the most important point is that if you see, they have also indicated that by the end of this year, most of the discretionary spends may come back to normal, including the travel spends as well. Now, if you look at significant section of the street has been of the view that after the pandemic, both the growth rates and margins will be structurally higher. But TCS sounding of caution on margins or let's say most of the discretionary costs coming back by the end of the year should be sort of an eye-opener, especially on the margin front. On the growth front also, as I said, I strongly believe, and looking at the data beyond this quarter and previous quarter also, most of the other sector data actually suggests that growth rates post the pandemic equilibrium should be more or less in line with the long-term pre-COVID average growth rates for the industry. In that context, if you see the valuations for the stock, historically, if you look at the long-term 10-15 year average valuations, cross-cycle average valuations for TCS, it would have been in the range of 19 to 20. Now it is trading at almost 30 times on FY23 basis. Incrementally, given the higher scope for disappointments over positive surprises, I believe that the risk-reward ratio is not very favorable at this juncture, and that's the reason which is driving our downgrade.
Sudheer, hi, and great call. When we spoke with you last, anti-consensus seems to be playing out, although, I mean, it's just the results of stock is yet to follow meaningfully. So does this have any implication for the broader IT bullish call? I mean, the consensus bullish call?
Yes, Prashant, thanks. Thanks for highlighting that point. Yes, I do believe that it has implications for the broader sector and not necessarily for TCS. So most of the companies, if you see, we have seen this trend of multiples getting spiced up significantly ahead of fundamentals catching up, earnings catching up. And accordingly, for most of the companies, including other large cap names, some of the other large cap names, most of the mid cap names that we are seeing, which are at a very trading at exorbitant valuations today. So for most of them, I do believe that incrementally going forward, there is a higher scope for disappointments over surprises. And the second point you should note here is that actually there are very few companies, let's say maybe one company across the large caps or maybe 1 or 2 companies across mid caps, which have been showing higher demand momentum or higher growth momentum compared to the pre-COVID levels. Barring these 1 or 2 companies across the sector, in the case of most other companies or stocks, you are seeing the same trend where the expectations got significantly spiced up. Both the post-pandemic growth and margin expectations got significantly spiced up. And street started expecting structurally higher margins, structurally higher growth rates. But for most of the other companies, it's still at an expectation phase. We are not yet seeing it in the numbers for any of the companies. As I said, any of the credible lead indicators or data that we have been tracking is not suggesting that sector will see higher growth rates. So TCS, it's just the beginning. The company has reported earlier than others, but we'll see a similar trend for most other companies also. I am reasonably confident that as the earnings season progresses, we'll see most of the companies reporting growth rates which are in the range of in line with pre-COVID long-term average growth rates.
Sudheer, we look forward to chatting with you when the others come out, the other IT majors come out with their numbers. But for now, I wanted to get your thoughts in on Zomato. Now, while it's a great success story in India and everyone's looking forward to that listing, there is a lot of concern which is being raised on the valuations. Even much larger global peers are trading at 6 to 9 times, sales, EV to sales, while Zomato is going to come in at almost 12 times EV to sales FY24. Now that seems to be very, very pricey, even into taking into account India's growth opportunity as well as the scarcity premium. Your thoughts on the valuation and what upside does it leave for an investor?
Rima, as you are aware, it's not a rated stock for us. We are not formally covering the stock, and it's in fact an unlisted company for now. So it would be very inappropriate for me to kind of make any comments on the valuations of that stock. So I hope.
Sudheer, that is the reason why you should be absolutely comfortable talking about it, because it's not rated.
No.
No, forget about valuations. Forget about valuations and all that. Broadly, to turn that question a little bit, not asking you whether investors should subscribe to it or not, but as a business per se, the food business did about $350 million in sales in FY20. 21 is a bad year, and growth rate should pick up in 22, maybe 23. But in a way, do you think that that business is got everything going for it right now? Starting with the fact that restaurants are shut, so people are ordering in more. The other point which is highlighted is that penetration is only about 10%. Now, but penetration of what? Penetration of overall, value of food consumed, restaurants, etc., or percentage of the addressable market? Just those two questions, Sudheer, without going into pricing, valuations, subscribe, not subscribe. Yeah.
Sure, Prashant. So on the first point, I don't think this is a very short-term phenomena whereby we are seeing lockdowns and most of the restaurants are shut. That's why people are ordering more. In fact, one interesting dichotomy I would highlight here, over the course of CY20 or FY21, if you see, for most of the global food delivery companies, they have almost doubled their revenues or grown their revenues 130, 140%. But if you look at Indian companies like Swiggy and Zomato, their revenue orders would have seen a sharp fall because of the fact that in India, we had more stringent lockdown. And outside the urban core, outside the top 20 cities, if you see, in most of the places, let's say most of the 500 markets that they operate in, food delivery is not considered to be a very essential service. Food delivery, the laws are, the lockdown rules and laws are written, implemented and interpreted in different ways. So they had seen a lot of logistical constraints in terms of continuing their business operations. So unlike what the global food delivery players had seen, a strong increase in adoption during the pandemic because the restaurants are shut, people were not willing to go out, Indian players had actually seen a sharp drop in the revenue momentum. So it's not as if because of the near-term lockdowns and all, these companies are seeing higher adoption. Actually, the data point is the other way around. But if you ask me in terms of the longer term, what are going to be the key drivers, I would highlight one point to you. If you look at the adoption of food delivery apps, let's say the number of users out of the number of smartphones, how many of those smartphones have either Zomato or Swiggy or both installed on their smartphones? If you see across the top 20 cities, we estimate this adoption, we define that as adoption, number of smartphones which have Zomato or Swiggy or both installed. So as per our estimates, ICICI Securities estimates, we currently believe that, let's say 16% of the, 35% adoption rate is what we are seeing in the top 20 cities in the country. But these companies have operations in almost 520, 530 cities. They have operations in most of the towns where there is greater than 100,000 population or greater than 50 restaurants. So if you look at the next 500 markets, the adoption rates are still very low, in the range of 16 to 17%. Because you should understand that these companies have shorter history of operations in these 500 markets. Secondly, there is limited networking effect for now because once they ramped up to these 500 cities, immediately lockdowns, etc. have started. So in terms of adoption, we see a significant scope for increasing adoption in the next 500 towns. Also because of the fact outside the urban core, if you see, the restaurant density is also very lower. The ambience quality of restaurants is also very lower. So what's happening is we are seeing a trend of significant cannibalization of dine-ins or footfalls into delivery activity. So outside the urban core is where you will see significant increase in adoption going ahead. In the top 20 cities, I would believe it will be more driven by the increase in the ordering frequency or increase in the basket size of the order.
Sudheer, it's a pleasure. Thank you very much for joining us, and I think that's a pretty sort of comprehensive look at Zomato without going into valuations or whether you should subscribe or not. But it's a longer term story, as Sudheer pointed out, and the trend is here to stay, even though at this point in time it may look a little pushed up because of the situation we are in, which is the hospitality sector under still a lot of restrictions, restaurants shut, etc. The market is down 70 points. We are at about, what,